Can you just give a trade example on this? If you have to take a hypothetical trade example, or which you have traded way back on this.
Yeah, absolutely.
Yeah.
So one example that happened, uh, well, some really good examples of it was during, you had situations during, you had longer dated vols, like 6 to 9 months vols, not like super long dated, but 6 to 9 month vols. They got very expensive around the time, that, what's oh my God, I had to close my bank account because of it. Around the time of the First Republic, a Silicon Valley Bank.
Okay.
During
Yeah.
this, yeah, I had a First Republic account that I had to now I have a Chase account, but because I had to roll into that. But
It was in 2022, right? The first bank it was
what's that?
2022. The Republican Bank thing happened in 2023 early, I guess, right?
23, yeah.
Yeah, 2023 early January, Feb, I guess.
Yeah, it was around 2 years ago,
Yeah,
like
yeah,
kind of around this time, a
yeah, yeah,
little like later in the spring, I think.
yeah.
And that was an example where you saw high realized vol because of this event, but you also got the long date, even the 6 month to 9 month vols went up a lot. So what the market was, it was interesting because it was like a portrait of uh systematic risk in a way. It's like the market was actually saying that this vol was going to last for a long time, this high elevated vol. But that to me looked a lot like that does not happen that often. And a trade that I tend to like there is to basically sell a calendar spread, because you can sell a long dated vol, buy the near dated vol, and then you're just basically wait, like your gamma's covered. You are going to pay a vol premium for it because it's in that situation, the near dated vol is going to be higher than the longer dated vol, because the stress is acute and right now. But if you sell that calendar spread, your gamma's covered. Like you're going to be long gamma, actually. You're going to pay theta. And when the market relaxes, you will, if the market relaxes back to sort of normal levels, the amount of money you'll make on the short Vega piece will compensate you for the fact that, your front month options are going to erode. But your front month options, they're going to go away. Like, yeah, you're going to get hammered on that stuff, but they are going to go away, and they've protected you in the interim. Another way of saying this is that you are selling a very expensive forward volatility. So your forward volatility between the expiry that you own and the expiry that you're short. So you're like, if you're long let's say it's January and you're long a March option and short a December option. Another way of arranging that in your head is that what I'm short is a March December forward.
Yeah.
So as we get closer to March, if the forward declines in value, I will win to that. And that trades off against, like, basically the tug of war between your gamma and theta between now and March. But if the vol comes in, you'll win on being short that forward. So this is an example of, like, you're looking at the situation saying that is a very expensive forward. And the thing is, you could go hedge it by looking for forwards in other places that, because one thing here is kind of interesting is, like, that's a systematic, the market's doing that because it feels like a systematic or structural risk. If the structural risk comes to bear, lots of assets are going to reprice themselves. In other words, like, correlations across the marketplace are probably going up. So if there are laggards on that, and there were, you could buy the forwards in those. And then what you have ultimately is like this forward vol spread on, where you're short the forward vol where the stress is acute, and you're long forward vols where it's not. And the idea is that if the entire thing really does become more structural, the ones that you're long have more to gain than the ones that you're short can go up any further. So if it turns out to be structural, you're hedged, and if everything relaxes, you just capture the spread anyway on the basically on the longer dated stuff coming in hard. So that's kind of but it's hard to see that if you don't look at things cross sectionally. It's kind of hard to see these relationships.